RBI has asked fintech players in India to slow down with loan disbursals. In a meeting recently held with fintech heads, RBI is said to have told many companies, especially those involved in loan products and or are operating as loan service providers, to cut down growth. Now, RBI's concern is that despite curbs in the risk weights in unsecured loans, there is little or no moderation in growth. While a few fintech leaders have communicated to the regulator that high growth is coming off a low base, the reasoning hasn't found favor. In fact, RBI has now set target growth at around 15 to 20%, and is a message that has come out clearly. While currently fintech lenders are among the fastest growing entities, almost every fintech across the board has clocked about 35 to 50% growth in financial year 24. But RBI is very clear, as far as your loan portfolio is concerned, Kartik, you've got to taper down growth.
So I think, this is something which honestly, Shweta, we had been expecting. And if you remember, not the monetary policy meet gone by, but the one before that, I think it was in the month of February, if I'm not mistaken. And, RBI Governor Shakti Das in his commentary at the MPC had pretty much said, and this is in the immediate aftermath of the Paytm crisis, Paytm Payments Bank crisis, had actually said that e-platforms, electronic trading platforms could perhaps be, he had hinted quite clearly that those could be the next sort of, bucket of platforms that RBI may want to scrutinize, in a little more detail. And the fact that Hindu Business Line has reported this story, we haven't been independently able to verify this. The fact comes by way of RBI in the month of November. Last year, on the 16th of November, if I remember correctly, had actually increased the the risk weights on unsecured loans. And that was done basically to ensure that there is enough capital adequacy with NBFCs, with banks, to ensure that any possibility of a ballooning loan going bust, there is enough capital set aside that it doesn't become a systemic risk. Now, that was obviously something that all NBFCs had to adhere to, and fintechs, by nature of the fact that they are not technically NBFCs but are platforms which connect borrowers to lenders, puts them in a little bit of a precarious scenario, because number one, they don't have money that they themselves are lending. They are pretty much acting as intermediaries, connecting an NBFC, let's say, for example, a Bajaj Finance, with a lender who, with a borrower who wants to take an unsecured personal loan, and their job pretty much ends there. So, at the banking and the NBFC end of things, I think this increased in risk weights has ensured that there is no chance of, or a lower chance of, those institutions going bust and falling under. However, in the case of fintech players, I think now what the RBI wants to do is, it wants to tell them that slow down on offering loans, even if these are not your own lending cycle. This is you connecting borrowers to a certain lender. Slow down on that loan growth, and that loan growth right now has clocked an impressive 35 to 50%, year on year, which you mentioned. But RBI wants to bring that down to about 15 to 20%. So pretty much half the rate of growth of unsecured personal loans being lent to unsecured borrowers.
I just want to break it down for our viewers, because it gets very complex. We keep talking about debt, we keep talking about loans. We're essentially talking about a non-mortgaged, non-housing loan, essentially a loan which could be for a consumer durable like a laptop or a PC or a phone. Now, RBI does not want this portfolio of loan to grow, essentially retail loan to people like you and me for small consumable items.
That's right. So, I think the categories that you mentioned again have some sort of, a very tangible requirement for you to take a loan. We don't know if there is data out there which tells you how many people are actually taking loan right now for more granular essentials. Could be education, could be maybe, something as simple as paying the child's next quarterly fee at school. So all of these come under the category of unsecured loans, because they are not secured by a mortgage, by a collateral, right? So since there's no collateral which is being served as a hedge to taking that loan, these loans become unsecured. So NBFCs and banks, by keeping enough capital adequacy, which got increased by 25% in the month of November, are hedging themselves that if X number of loans in their overall portfolio were to go bust, then that institution can withstand that loan going bust and is not going to become a systemic risk.
So I want to throw this question to you
Yeah.
because you're someone who believes that as long as people are buying in and they're paying those loans back and it's not turning into an NPA, there is no problem. Why does RBI have a problem with this ballooning loan segment as long as people are paying back and servicing their debt in due time, in due course?
Right. So, I think in the absence of very, very credible data which tells you what is the default rate, it is difficult to take a stand on whether those ballooning loans are good for consumers or bad for consumers. You know for a fact, if all these are leading to consumption, and consumption by virtue of consumption being almost 55% of India's GDP, it ensures that at least people are making purchases today, which are adding to India's economic growth today. But if the number of people taking these loans for consumption begin to default on these loans, then it leads to a systemic risk. And that could be perhaps the RBI's, fear right now.
Right.
So, fintechs in all of this actually find themselves in a very precarious scenario. At one level, they need to abide by whatever norms and guidelines that the RBI wants to set on them, and literally telling them as a regulator to slow down on their loan dispersal. At the same time, these fintechs are heavily invested in companies, and they've got to show some aggressive growth back to their investors to stay in the business and to get more funds and for their own overall valuation to to only grow. So fintechs, they seem to be now in a very precarious scenario that should you pursue growth at all costs or should you slow down growth because the regulator doesn't want you to grow that fast.
All right, but RBI making it clear there that it does not want retail loan, non-mortgage, non-collateral loan book to grow, perhaps hinting at the fact that there is some data out there on loan servicing that is not out just as yet. We'll continue tracking that story for you.